Hey, it's Clint, Larry's analyst over at the Opportunistic Trader, and I want to talk with you today about tracking the stock market into the new year. If all you are following is the S&P 500, you are not tracking the stock market. If all you are following is the Nasdaq 100, you are not tracking the stock market. If you are following those two popular indexes as your guidepost for what the stock market is doing, you could be at risk. You could be missing some opportunities. And today, I want to explain why that is. So let's go into a few charts. All right, so why is this? That is because over the last several years, the S&P 500 has been moving further and further away from representing what the average stock is doing. And that is because of several of these mega cap names. Yeah, you're familiar with the Magnificent Seven names and the milestones, the records that companies like NVIDIA are setting for market valuation. Well, since the S&P 500 is weighted by market cap, those bigger companies get a larger share of the index. So it's a capitalization weighted index. And what the line on here tracks, this orange line on here tracks, is the weight of the top 10 companies in the S&P 500 index. This chart comes from Macro Micro. And you can see this line is gradually started increasing back around 2016. It had stayed in a pretty confined range going all the way back to about 2000, never topping above 15, 16%. Then we started to gradually see this increase. Well, look at where we are right now. Over 40% of the S&P 500 is in the top 10 stocks. So just 10 stocks make up over 42% of the index. That is why I am saying this index is no longer representative of what the average stock is doing. This is record concentration. This is higher than anything we've ever seen before. Concentration is even greater in the Nasdaq 100. If you look at the Nasdaq 100, it is over 50% weighted in the top 10 names. And so the indexes at this point, the most popular indexes out there, are being absolutely dominated by these mega cap names to like nothing we have ever seen before. And the composition is unlike anything we've ever seen before as well. And so that's what the next chart I want to share with you. This comes from JP Morgan. This is really interesting. So it looks at my Hedge block in the 2025 marker down here. But this looks at the top 10 companies in the S&P 500 in 2025, what that looked like a decade ago in 2015. Go back another decade, 2005, 1995, 1985. It has the total market cap of the combined top 10 listed here, but what you want to do is you want to standardize that by looking at what percentage of that it makes up of the S&P 500. This is at the start of 2025, so that's why this number is not over 40% on here. But you can see, again, comparing the top 10 in terms of what it comprises of the S&P. But then what I found was interesting was going through and looking at the types of names that make up the top 10. And looking back, when you go back to the 40 years ago, there's a lot. IBM. There's your one tech company in there. A lot of industrials and energy. So ExxonMobil, Shell, Royal Dutch, then GE, General Motors, and you kind of see this mix going through of energy, industrials. You start to see retailers, Walmart. Consumer goods companies, P&G coming in here. And it stays that way, for the most part in 2005. What the thing about it was interesting, you see Exxon as a top 3 stock all the way through 2015. You get to 2025 and it's dominated by tech. You get, obviously Amazon is tech, but also retail, Apple, consumer products. But, the tech side of thing really shines through. You've got, Berkshire and JP Morgan up here, but just how, looking across, at least these 7 or 8 names or so in the sectors they're in and what they do versus what used to comprise that top 10 historically. Now, here's where I talk about, some of the, so if you've been a buy and hold investor in SPY, especially for the last couple years since this cyclical bull market started in late 2022. You've certainly been rewarded. I mean, these stocks have driven, as they've gained in value, they're driving the S&P 500. They've been responsible for well over 50% of the gains in the market since this bull market began. But just as it was a benefit on the upside, it can be a risk on the downside as well. And so just to illustrate, this point, just very recently at the start of December, the S&P, it's hovering near the highs. I mean, it's not like we've had a large drawdown pullback or anything like that, but it's been struggling to get out and make a new high. And one reason for that is because you've had a lot of these Mag 7 names have been starting to lag here a little bit. So, NVIDIA, captures this perfectly. NVIDIA had this pop into late October, but it's pulled back. It's actually trading below its 50-day moving average as I'm recording this, and is hovering near the lowest levels of the past 3 months. And this is significant because NVIDIA alone is 8% of the S&P 500. So in a lot of these stocks, these Mag 7 stocks, are leveraged to very similar themes, whether it's AI, data center build out, semiconductors. There's a similar theme that is going to, similar cows that's going to impact a lot of these names. So it would be reasonable to expect their share prices to be somewhat correlated, positively correlated, and move together. And so, when you have, just like these things were a big boost to the S&P 500, that can work against you in the other way as well. And that is why I say this is, a big risk in terms of how you want to track the stock market, especially into 2026. If you start to see trends like this persist, it may look like the S&P struggling. If you're holding SPY or if you're holding QQQ, it may feel like you're going nowhere. But, on the flip side, you could have the average stock actually doing quite well, and you can miss out on that if you don't know where to look to track that. And so, and that's exactly what we've been seeing to close out this year. And so while NVIDIA has been struggling a little bit here recently, you have the equal weight S&P 500 index breaking out to new record highs. So the average stock, instead of the Mag 7, it's the other 493 that's providing a bump, at least here recently. So this is the equal weight index. Again, so for the S&P 500, instead of being cap weighted, it's just going to equal weight across all stocks. NVIDIA would be treated just like any other name, and so on. And there is an ETF that tracks this. The ticker is RSP. So that's one way to watch what the average stock is doing. And I would keep track of this. I would track what the equal weight index is doing relative to the cap weighted index, because again, if we start to see these Mag 7 names begin to struggle at all, it's given their sheer weight, their sheer dominance of the index, that could really weigh on things here. So keep an eye on the average stock. Another way to keep track of this is with the NYSE's advanced decline line. So any given day on the New York Stock Exchange, you can look at the number of stocks that are moving higher versus the number of stocks that are moving lower, take a difference between those two, and go back historically and just add it to the prior day's total. And you can come up with this line on here. So that's all this is. It's just tracking the cumulative tally of this advancers minus decliners on the NYSE. And, what I want to show is that this originally peaked out back in September and has just been grinding sideways ever since. Tried to make a new high back here in October. Then we had a pullback, but now we're at a new high once again. We'll see if this holds right here. But again, if you're tracking, if all you're watching is the S&P 500, then you might be missing this. So there's you need to be watching for trading opportunities outside of the Mag 7. And I think this could be, given the concentration in the indexes, this could be a really key theme to keep an eye on as we head into the new year. Go back and look at the internet bubble and, what happened in the late 1990s and early 2000s when when that bubble eventually peaked and started moving lower, in 2000 and 2001 in particular, small and mid cap stocks on the value side of things actually did extremely well. So you had the S&P 500 pulling back because you had heavy concentration in tech names. Same with the Nasdaq. But if that's all you're watching, if you're only holding equities, that track that index, you were missing out on some other big opportunities elsewhere. And I think it's very reasonable to expect something similar as we go into the next year.